Everyone tells you to max out that 401k if you want to retire comfortably. The idea is really simple. The more money you put in, the better off you'll be later. But here's the truth. Maxing out that 401k the wrong way could actually mean paying higher taxes in the future. The key isn't just saving money, it's saving the right type of account. And today I'm going to show you why using Roth is often the smarter move. Hi, I'm Scott Grosskreutz, president of SG Financial. I've worked with countless families who wrestle with the same question. How do you save for tomorrow without sacrificing today? The turning point always comes when those planning for retirement get that clarity on what retirement really costs, and they discover that freedom to enjoy life right now. When you put money into a traditional 401k, it lowers your taxes today. It feels like a win, and you pay less tax now and push that bill far into the future. But that bill doesn't go away. When you retire, the IRS makes you take that money out. Every dollar is taxed like regular income. If you've done a good job saving, you could end up paying a higher tax bracket much later on. With Roth, you don't get a tax break today. At first, it feels worse, but that paycheck is smaller because you're paying taxes now. But in retirement, it's all tax-free. No forced withdrawals, no surprise bills. You've already paid your share, and now that money is yours. The choice between Roth and traditional usually comes down to the 24% tax bracket. If you make less than about $197,000 as a single filer or $395,000 as a married couple, Roth usually makes a lot more sense. Now you pay taxes now at a reasonable rate, and every dollar grows tax-free in the future. For example, if you contribute $10,000 to Roth while in the 24% tax bracket, you'll pay about $2,400 in taxes today. But the full $10,000 goes into your account, and that growth is tax-free. If you're in the 32% tax bracket or higher, traditional often works a lot better. You get a bigger tax break today. Let's say you put in $10,000 into a traditional 401k at a 32% tax bracket. That saves you about $3,200 in taxes right now. Later, you may have a chances to just convert some of that money into Roth when your income drops and pay less taxes than you would even today. There's also a sweet spot for Roth conversions. That window is often the years right after you retire, but before Social Security and before required withdrawals kick in. In those years, your income may be lower and you can move money into traditional to Roth at a better tax rate. Skip that window and the IRS will force bigger withdrawals later, which could push you into a higher tax bracket and cost you more. Now let's talk about the debt problem no one likes to bring up. Our government debt has climbed to more than $37 trillion. And the only way to pay for it is through higher taxes on us. That makes it very likely that tax rates could go up in the future, which means traditional contributions today could eventually be taxed at a much higher rate tomorrow. Take John as an example. He's 50 years old, he's married, making $300,000 a year, which places him in the 24% tax bracket. In that case, he should be focusing on Roth contributions, but if his income were to climb into a higher tax bracket, it might make more sense to just move it into traditional before retirement. Here's the key. A dollar Roth is not the same as a dollar in traditional. Every Roth dollar is yours. If you put in $23,500, that's $23,500 you can spend later. With traditional, that same money might only be worth $17,860 after taxes. That's really why Roth dollars are way more powerful. They give you tax-free growth, no forced withdrawals, more flexibility later, and use at the right time when you're that lower tax bracket during those conversion windows. They can really make a massive difference to your retirement. If you found this helpful, hit subscribe for more strategies just like this. Your future is too important to wing it. Visit sgretire.com and discover how you can build a fulfilling retirement.